listen to me very carefully right now, because what I'm about to tell you in the next 25 minutes is going to be more valuable than anything your financial advisor has told you in the last 10 years. And I say that not to flatter myself, but because your financial advisor is either too scared to tell you the truth or too poorly educated to know it themselves. The petrodollar system, the invisible financial architecture that has kept your savings worth something, that has kept your 401 kilobits from evaporating overnight, that has allowed the United States to run deficits that would bankrupt any other nation on the planet, is dying right now. Today, as you watch this video, not next decade, not in some distant theoretical future that economists argue about over lunch, right now, and the brutal, cold mathematical reality is this: most people watching this video are positioned exactly wrong. You are holding exactly the wrong assets in exactly the wrong currencies, and you are about to find out what that costs you in real dollars and real purchasing power. The question is not whether this transition is happening. The only question that matters is whether you are going to be on the right side of it or the wrong side of it, because there is no middle ground here. There are winners and there are losers. And the difference between the two is not luck, it is not connections, and it is not how much money you started with. It is knowledge. And specifically, it is the knowledge that the people sitting in the big glass towers on Wall Street have had for 50 years and have very deliberately never shared with you. Before we go any further, if you are not subscribed to this channel, you are making a financially illiterate decision right now, and I say that with complete seriousness. The frameworks I teach on this channel are the same frameworks that institutional investors use to manage billions of dollars, and you are getting access to them for free. A private education at a top business school will cost you $200,000 and still not teach you what I teach. Here, hit the subscribe button and turn on notifications, because the video I post next week could be the single most important financial decision you make this year. Do it now, before you forget, because forgetting is exactly how most people stay broke. To understand why everything is changing, you need to understand what the petrodollar actually is, because most people throw that word around without genuinely grasping the machinery underneath it. And if you do not understand the machinery, you cannot possibly understand why its breaking down is so catastrophic for your specific financial situation. Let me take you back to 1974. Richard Nixon had already taken the United States off the gold standard in 1971, which meant the dollar was no longer backed by anything physical. It was backed by trust. And trust, as any serious investor will tell you, is an extraordinarily fragile foundation for a global reserve currency. So the question became, how do you force the entire world to keep trusting the US dollar and keep using it? The answer was Saudi Arabia. In 1974, the United States struck a deal with the Saudi government that was frankly one of the most strategically brilliant financial maneuvers in modern history. Saudi Arabia agreed to sell its oil exclusively in US dollars. That was the deal. That was the entire thing. And what that meant in practice was absolutely staggering in its implications. Think about what that actually forced every country on earth to do. If you are Japan, and you need oil, and every barrel of oil on the planet is priced and sold in US dollars, then you need US dollars. You cannot show up with yen. You cannot show up with Deutschmarks. You need dollars. So what do? You go out in the world and you earn dollars, you sell things to Americans. You trade in dollar-denominated markets. And then critically, because you are holding dollars and dollars sitting in a vault earn you nothing, you buy US government debt, you buy treasury bonds, you park your dollars in American debt, and you earn a little interest on it. And in doing so, you become a permanent structural buyer of US government borrowing. Every country on earth, from Germany to China to tiny nations you have never heard of, became a captive buyer of American debt simply because they needed oil and oil cost dollars. The result was that the United States could run deficits that would be considered absolutely insane for any other government on the planet, and the world would just keep buying the debt because they had no alternative. That is the petrodollar. That is the 50-year engine that made the American financial system the most powerful in human history. Now here is where the cold water hits you in the face. That engine is sputtering. The BRICS nations, which now include Brazil, Russia, India, China, South Africa, and a growing list of others, are actively trading with each other in local currencies. They are cutting the dollar out of those transactions deliberately and systematically. Russia is selling oil to India in rupees. China is buying Gulf oil in yuan. Saudi Arabia itself has begun accepting payment in currencies other than the dollar for the first time in 50 years. The Middle East, far from being simply a regional conflict zone that you can comfortably ignore, is actually the front line of this currency war. Every time a major oil transaction happens outside the dollar system, it is one less country that needs to hold dollars and one less country that needs to buy US Treasury bonds. And that matters to you in your living room in a way that is going to become very painful very quickly if you do not understand the chain reaction that follows. Here is the chain reaction. And I want you to follow this mathematics very carefully because this is exactly where most investors get lost and exactly where the damage to your net worth is going to come from. When countries around the world stop needing as many dollars, they start selling the dollar-denominated assets they already own. The biggest of those assets, the one they own in the largest quantities, is U.S. Treasury bonds. So they start selling bonds. Now, when bond supply goes up and demand goes down, what happens to the price of those bonds? It falls. Basic supply and demand, the same principle that governs every other market on the planet. Bond prices fall. Now, here's the part that confuses most people who have not spent time understanding fixed income markets. When bond prices fall, interest rates rise. This is not opinion or theory. It is mechanical. It is mathematical. The yield on a bond moves inversely to its price, always, without exception. Because of the way bond yields are calculated, bond prices fall, interest rates rise, full stop. Now, what happens when interest rates rise? The cost of borrowing money goes up for every company in the United States. Every company that needs to finance its operations, its expansion, its debt refinancing, suddenly finds that money is more expensive. And when money is more expensive, future profits get discounted at a higher rate. And when you discount future profits at a higher rate, the present value of those profits goes down, which means stock prices go down. This is not some obscure academic point. This is the direct mechanism by which the death of the petrodollar translates into a number going down in your brokerage account or your 401 kilobits. The sequence is this. The dollar loses reserve status. Countries sell treasury bonds. Bond prices drop. Interest rates spike. Stock valuations collapse. And at every single step of that sequence, the person holding conventional dollar-denominated assets gets poorer. Now let us talk about what this does to the people who think they are being safe. If you are sitting in cash right now because the market looks uncertain and you are waiting for things to calm down, I need you to understand something with absolute clarity. Cash is not a safe haven in a dollar debasement scenario. Cash is the worst possible place to be. If the purchasing power of the dollar declines by 30% over the next 5 years, and I'm not saying it will, but the historical precedent from every other reserve currency transition in history suggests that is not an unreasonable number, then your cash position loses 30% of its real value while sitting completely still in a savings account, earning 2% annually. You are not being safe. You are slowly being robbed in a way that does not show up on your bank statement. Your pension, if it is denominated in fixed dollar amounts, is experiencing exactly the same erosion. Your salary, if it does not keep pace with real inflation rather than the government's reported inflation figure, is losing ground every single month. This is the wealth transfer that is already underway, and the people on Wall Street understand it perfectly, which is exactly why they are not sitting in cash and they are not sitting in long-duration treasury bonds. Now, I want to talk about something that very few financial commentators are paying any serious attention to, and that is the strategic importance of Cuba, which I recognize sounds strange. But stay with me because the numbers here are genuinely extraordinary and the opportunity they represent is one of the most significant that I've seen in my career. Cuba is not just a politically complicated island 90 miles off the coast of Florida. Cuba is, in terms of its mineral wealth, one of the most strategically valuable pieces of geography on the planet right now, at exactly the moment in history when the world is scrambling to secure the raw materials needed for the next 50 years of technological development. Let me give you the specific numbers because this is where it gets concrete. Cuba holds among the world's largest deposits of cobalt, and cobalt is not some obscure industrial metal that you can afford to be uninterested in. Cobalt is the critical material inside every lithium-ion battery on the planet. Every electric vehicle, every smartphone, every laptop, every grid-scale energy storage system requires cobalt. And demand for it is projected to increase by several 100% over the next 2 decades as the world electrifies its transportation and energy systems. Cuba is the 5th largest cobalt resource in the world. That is not a minor footnote. That is a geopolitically critical asset. Beyond cobalt, Cuba has massive nickel deposits, and nickel is equally critical for battery technology, for stainless steel production, and for aerospace applications. There is copper, which is essential for every electrical system and every renewable energy installation on the planet. There are rare earth elements, which are required for the permanent magnets in electric motors and wind turbines. There is gold and silver, which are hard assets whose value becomes self-evident in exactly the kind of currency debasement environment we have been discussing. The reason none of this has been developed to anywhere near its potential is embarrassingly simple. Cuba does not have investment capital. Decades of communist economic mismanagement and American embargo have left the country's mining sector dramatically underdeveloped, which means the resources in the ground, the geology is known, the deposits are mapped, and essentially nothing has been done with them at scale. The United States, which is now systematically repositioning itself as a Western Hemisphere economic power rather than a global policeman, has begun the process of cutting off Cuba's external support systems. Venezuela, which was supplying Cuba with subsidized oil, is now under a different political alignment. Iran, which provided Cuba with financial support, is increasingly isolated. When those support systems disappear and an economically desperate Cuba needs investment to survive, the United States will be in an extraordinarily powerful negotiating position. The Venezuelan playbook, where regime change opens up massive oil reserves to American processing and export, is likely to be repeated 90 miles from Florida, but with mineral wealth rather than oil as the prize. This brings me to what I call the great reshoring, and this is where the macro story translates into something you can actually act on as an investor. Because understanding that the world is changing is not enough. You need to understand specifically where the capital is flowing, because that is where the opportunity lives. For roughly 30 years, the dominant economic logic of global trade was to make everything as cheaply as possible, which meant moving manufacturing to wherever labor costs were lowest, primarily China and Southeast Asia, and then shipping the finished goods to wealthy consumers in America and Europe. That model is now being dismantled, not gradually, but with considerable urgency, driven by a combination of geopolitical risk, supply chain fragility that became brutally obvious during the pandemic, and a deliberate U.S. policy of reducing dependence on potentially hostile nations for critical goods. The reshoring trend means that manufacturing is coming back to the Americas. Not all of it, and not overnight, but the directional shift is unmistakable, and the capital flows are confirming it. Companies are building new semiconductor facilities in Arizona and Texas. Pharmaceutical manufacturing is being repatriated. Defense supply chains are being redesigned to eliminate single points of failure in hostile jurisdictions. And beyond the United States itself, the concept of friendshoring, which means moving supply chains to politically aligned nations rather than necessarily to the cheapest possible location, is redirecting enormous investment flows to Mexico, to Colombia, to Brazil, and to the broader Latin American region. This is creating demand for infrastructure, for energy, for mining, for logistics, and for financial services across an entire hemisphere that has been largely overlooked by institutional capital for the past 3 decades. The smart money does not wait for this to be obvious. By the time it is being discussed on mainstream financial television, the early movers have already captured the majority of the gain. Think about gold mining stocks. The thesis for gold became clear in the early stages of this dollar debasement narrative, and the investors who understood the framework and positioned themselves early captured gains of 150, 200, even 300% before the mainstream press started writing favorable stories about gold. The same pattern, the same early mover dynamic is now setting up across the entire critical minerals and Americas. Infrastructure space and the window to get positioned at the early stages is not infinite. So let us talk about the actual action plan, because I am not in the business of giving you interesting macroeconomic analysis and then leaving you with nothing concrete to do with it. That is what university professors do. What I'm going to give you is a framework, a set of principles for positioning yourself correctly. And I want to be absolutely clear that I am not giving you specific investment advice. I am giving you a way of thinking that you can then apply with whatever resources and risk tolerance you have available. The first principle is this: reduce your exposure to long-duration dollar assets immediately and deliberately. Long-term treasury bonds are not a safe haven in this environment. They are the single most exposed asset to exactly the risk we have been discussing, which is rising interest rates driven by falling demand for U.S. government debt. If your 401 kilobits has a significant allocation to bond funds, and particularly to long-duration bond funds, you need to understand that you are holding an asset that is structurally positioned to lose value in the scenario that is now unfolding. This is not speculation. This is a direct consequence of the mechanics I walked you through earlier. The second principle is to build exposure to hard assets. Gold has been the canonical hard asset for thousands of years of human financial history, and it performs exactly as expected during currency debasement cycles. But gold is not the only hard asset that matters in this particular moment. Silver, which has both monetary characteristics and enormous industrial demand from solar panel manufacturing and electronics, is in a very compelling position. Copper, which is essential for every electrical system on the planet and whose demand is going to increase dramatically as electrification accelerates, is a hard asset with a strong structural demand tailwind. The critical minerals I have described, cobalt, nickel, rare earths, are hard assets with explosive demand growth projections. When you look at where to build hard asset exposure, you are looking at physical holdings and you are looking at the mining and extraction companies that produce these materials, paying particular attention to companies that have operations in the Western Hemisphere and specifically in the Caribbean and Latin American region. The third principle is to look at the infrastructure and construction plays associated with reshoring. When manufacturing comes back to the Americas, someone has to build the factories, the ports, the roads, the power systems, and the data centers. The companies positioned to execute that construction, to supply the materials, and to provide the engineering and project management services are going to see demand that dwarfs anything they have experienced in recent decades. This is a multi-year, potentially multi-decade theme, and companies with strong positioning in North American and Latin American infrastructure are worth serious research attention. The fourth principle, and this is perhaps the most important one, is to learn how to read money flows rather than news headlines. The news will tell you what is happening. Money flows will tell you where the smart money is going before it is. News, volume patterns in stocks, unusual options activity, the behavior of sector ETFs relative to the broader market. These are the signals that institutional investors use to identify where capital is rotating before the rotation becomes obvious to the retail crowd. By the time you read about a sector in a major financial publication, the easy money has usually already been made. Learning to read the signals earlier is the single highest value skill you can develop as an investor, and it is a learnable skill with a defined set of rules, not some mystical gift that only certain people are born with. What you want to avoid is the temptation to do nothing because the picture seems overwhelming or complicated. The complexity is real, but it is navigable, and the cost of doing nothing in an inflationary, currency debasement environment is not neutrality. Doing nothing is a decision to become poor in real terms every single year, and most people make that decision passively without ever understanding that they made it at all. If you are dependent entirely on a salary that does not adjust for real inflation, you are losing ground. If you are dependent on a fixed pension in dollar terms, you are losing ground. If you are holding cash because you are scared of the market, you are losing ground. The asset owners, the people who hold things that go up in price when currencies go down, are the ones who maintain and build wealth through these transitions. And the barrier to becoming an asset owner is not as high as most people believe. I am going to finish with a challenge, and I want you to take it seriously because I am issuing it with complete sincerity and zero interest in softening it for your comfort. You have just spent 25 minutes learning more about the actual mechanics of global finance than most people learn in a lifetime of watching mainstream financial news. And now you face a choice that is as binary as any choice you will ever make about your financial future. You can close this video, go back to whatever you were doing, and trust that the same system that has been quietly eroding your purchasing power for decades is going to somehow start working in your favor without you doing anything differently. Or you can decide that today is the day you stop being a passive observer of a wealth transfer that is happening with or without your participation and start being someone who understands the rules of the game well enough to play it. The petrodollar is dying, the great reshoring is underway, the mineral wealth of the Western Hemisphere is about to become the most strategically contested resource on the planet. These are not predictions. These are processes that are already in motion, already being acted on by institutional capital, and the only question is whether you will be early enough to benefit or late enough to watch from the sidelines while other people capture the gains. Subscribe to this channel, share this video with one person in your life who needs to hear it, and make the decision right now, not tomorrow, not after the next market dip, right now, that you are going to be on the right side of this because the window is open today, and windows like this do not stay open forever.